Hello everyone and welcome to the second episode of All About Day Trading. Today we're going to focus on the Fibonacci Retracement tool. Many of y'all maybe know this one because it's a very famous analyzing tool and everyone should use it in my opinion. I'm also using it daily. It's very important to me, and yeah, today we were going to talk about the basic things about the Fibonacci Retracement tool, what you have to know and what 90% of the people are doing actually wrong. Because in theory, it's very easy to use, but it happens that many people, especially new traders, are interpreting wrong things into the charts in order to use their Fibonacci retracement tool because they are chasing entries. What I mean with this will be explained very soon. I hope you will enjoy the video. And yeah, I would say let's start in. So basically, at first I will show you how to actually use the Fibonacci retracement tool. When do you use it and for what? I mean, the first rule you have to follow when you're using the Fibonacci retracement tool is that you only use it in trends. The Fibonacci retracement tool is a trend-based tool, and it wouldn't make sense to use it in a sideways trend, right? I will show you an example. I will do two different scenarios. 1 second. So we have two different scenarios here. We have at the left as I would say, healthy upwards trend, and at the right we see a sideways movement. And many people that are like chasing for entries or are not patient enough don't really care if it's valid to use the Fibonacci retracement tool. They just want to, as I said, chase entries. They want to make money quickly, and this is what makes them interpret wrong things into the chart. So in order to use the Fibonacci retracement tool, we have to do new highs or new lows, depending on which direction you're trading to, right? So we need the structure to break constantly in order to be able using the Fibonacci retracement tool. And the retracement tool, as it says in retracement, it's basically a strategy where you search for re-entries in a upwards or downwards trend. In this case, it will be the upwards trend to follow the main trend, right? You are looking for re-entries. This is called what you see right here. This down movement here, I will mark it, is called a pullback from the actual impulse from before. We were going up, we broke the structure, and we came back down again. This doesn't mean we are bearish. We are just temporarily going down. We are doing a retracement slash pullback, and this is a opportunity for us to get into the market again, right? And this is where the Fibonacci retracement tool comes in. You have, I would say, three major Fibonacci retracement zones and a few minor ones. I will show them to you. So we have three major Fibonacci retracement zones. The first one, it's very easy to memorize because they are very close to each other. The first one is the 0.362 zone. The second one, the 0.5. And the most important one, also called the golden zone, is the 0.618 zone. Most probable zone for the market to reverse and go up again to break the structure, right? These are the main major Fibonacci retracement zones we're looking at when we are searching for a reach entry, right? But there are also minor zones. You have the 0.786 zone. This is like the, I would say, last opportunity for me to get in to search for confirmation for reversals. This is like a very low retracement, which is happening quite often in Forex. This is, you have to take care when you're trying to re-enter into the market in upwards trends, because many people would go in at the golden zone saying, all right, most probable zone, I will go in here. Well, the market can also go deeper if you are not waiting for confirmation, can hit the 0.786 zone. This is happening quite often, to be honest. Get liquidated and go and, just get stopped out from the actual movement. And this is very important. I was talking about the golden zone before, the 0.618 golden zone. Of course, yeah, this is the zone where the market, let's say, reacts mostly, right? But this is not a guarantee. Very important. It doesn't matter what kind of zone you're trading, you always have to wait for confirmation. And we have another minor zone. We have the 0.705 zone. I mean, this is not really relevant. I'm not really using it very often. So the main, I would say I'm using 4 different Fibonacci retracement levels: the 0.362, 0.5, 0.618, and 0.786 zones. This is the ones I'm actually focusing on, right? And the question is, when do I know which Fibonacci retracement zone is the safest? This is very easy. Before I want to show you why you couldn't use the Fibonacci retracement tool here. I completely forgot it, sorry about that. But the difference between this scenario and this scenario is that in this scenario, you're not constantly breaking the structure. Like, you are in between this range. And one example, if you are using a Fibonacci retracement tool, for example, wait, I'll try to reconstruct it very quickly. All right, so just imagine here's the 0.618 zone. Basically, the golden zone we were just talking about, right? Many people would say, okay, golden zone must be safe. I will enter. What are they doing? They're entering here, placing their stop loss here, slightly under the last major zone, and targeting the previous high. This can work. I'm not saying this is not working. This is impossible. I'm not saying this. But the probability for this to work out is very, very low, because you should only use the Fibonacci retracement tool when you are actually in a sustainable and healthy trend. This is very important, right? So in this case, you got stopped out. You almost hit your TP before it came down again. Why? Because we are not actually bullish. We are like sideways. We are in a kangaroo market, how analysts would say. And yeah, this is why you shouldn't use Fibonacci retracement tools in sideways trends. So if you know you are stuck between a swing high and a swing low, you shouldn't be using the Fibonacci retracement tool. This is like the, let's say, the most obvious sign for greed, because you're chasing your entry. I mean, you're not really searching for a high probable setup. You're just desperately searching for entries, right? So only use it in sustainable and healthy trends. So I would say this one was very clear and very easy. And now we come to the second question, which I wanted to say before, but then I got interrupted by this scenario. When do we target which Fibonacci retracement zones? And this is very interesting, because I will show it to you. So we have 2 different scenarios again. I mean, I think you already know what this is going to be, but I will explain you when to target which zones. This is like a very easy example, because the stronger the trend, the lighter will be the retracement. Right. So write this down. It's very easy. The stronger the trend, the lighter will be the retracement. You cannot expect the markets. I mean, we can do another example. 1 second. So you cannot expect the market to be going down into the golden zone. Everyone is talking about like the safest zone of all time. This is only the only zone you should trade. That's bullshit. And I will explain you why. But I will just finish this. So when we're looking at this example, we see that the impulse is always very, very strong, right? And like the stronger, and you can measure it with the Fibonacci extensions, you see that the markets previously, in this case, you'll be looking here when you're looking at the retracement, and you see the market was previously only going until the 0.362 retracement. You know that the market will probably not come here, because many people would wait until the 0.618 zone, until the golden zone would be somewhere around here, and they would be surprised if the market doesn't touch this zone, because they would be like, oh no, I got left, I couldn't enter to the market. And then they are getting like greedy, and they go in at a very bad spot. But it's just about the strength of the market, right? So if you see that the market is very strong, you search for higher Fibonacci retracement levels. The same goes for the second scenario in this case. I mean, if you see this, right? Just let's delete this right here. If you see this kind of trend, you know that the trend is very, let's say, light. It's not very strong. Retracements are going very deep, and impulses are very light, right? As I said before, we saw that we only made this right here. You know, it's not very, I would say it would be like, it would be similar to this scenario, just a little bit lighter, like. And in this case, we wouldn't be, let's draw it in, wait. So in this case, we wouldn't be entering here like we did here, because we can obviously see, I mean, if we are using our eyes, right? If we look at the chart and see on how deep did the previous retracement go, how far did the following impulse go, we can see, or we can like measure what is the highest probability, or how deep the retracement tends to retrace, right? And it's definitely not here. I mean, if the market comes here, it was probably show a slight reaction, because the market loves to manipulate, let's say, mentally weak people. People would go in, they would say, okay, we have the previous high right here, support area 0.362, Fibonacci retracement zone. Let's go in, let's make money. And what happens? Whoops, liquidated. Why? I have waited for confirmation. Why didn't it work out? Yeah, because you were going in way too early. And this is the case. I mean, in this case, we would be looking at this area, right? We would be looking at this area somewhere here. So like I did before, of course it can. It's never about guaranteeing something. This is market analysis. It's always speculation, but it can, of course, go up again. This can happen. I'm not saying it's impossible, but the highest probability would be somewhere here, like before, right? So we would wait until the market comes here, wait for confirmation, right? And as soon as confirmation is shown by a low time frame change of character or any candlestick pattern, you can try your best and, let's say, enter and hope for the best, right? So this is what you should be doing. So yeah, this is everything I wanted to show theoretically. I can also show it to you in a real example that happened to me. Wait, I will show it to you, 1 second. So right here we can see an example of one of my trades. One of the trades I have lost. It was very recently. It was the 28th of June. It's right here. I mean, I can this. And the question is, why didn't it work out? Right? We had a change of character. The impulse was decent, and I expected the market to retrace somewhere around here to the golden zone. The problem is, I did one mistake. One drastic mistake that costed me a lot of money in the past, and this is not waiting for confirmation. Usually, it's right to go with the trend. You should never trade against the trend. But even if you're trading with the trend, you should always wait for confirmation. Because in this case, yeah, we had a change of character here, but we came here, this candle was very strong, so I was trying to catch a rocket just flying to the moon, and it obviously didn't work. Like, it came down again, but it eventually stopped me out. And yeah, at first I was surprised, but afterwards, when I was journaling my trade, I was seeing that this was far away from being any kind of confirmation. We saw a big ass bullish candle and some light, not really significant bearish candles afterwards. So even if you're trading with the trend, and we had a freshly made change of character, we had a lot of space left, like until here, right? You still have to wait for confirmation. And the confirmation opportunities would be, I can show it to you, bearish engulfing candle, for example. This could be one example, one confirmation example, or for example, a hammer candle. This is also yeah, very significant and safe confirmation candles you can use to make your entry safer. In this case, it was none of those. We had a bearish, very bullish candle, and yeah, and it caused a loss. It was very unnecessary. I just could have waited for confirmation, which was not found here, so I wouldn't have entered the trade in the first place if I would be waiting for confirmation all the time. But it happens. We're not perfect. That's why we journal trades. That's why we learn from our mistakes, and this will hopefully not happen again. And this was one example I wanted to show you. But here you can also see that the markets, like the lighter the impulse goes, the deeper it retraces, and the same goes for. I mean, here it's a perfect example. For example, here you can see that the impulse was like light. I mean, we can compare it to the Fibonacci extensions too. We can see that the market only got until the 1.362 extensions area, and it came back all the way down again. Here, it touched the 0.618 zone perfectly. But afterwards, in this case, for example, we saw that the market only tapped. We can see that the market didn't even touch the 0.362 area. And this is not just a coincidence. It's because the impulse was very, very strong. We came very high. I can show it to you. We came until where we came higher than 1.618 zone, and I mean, this is significant. Then we cannot expect the market to come here or here, right? So it's possible, but the probability is not very high. So we always have to measure how strong the actual impulse is to calculate how deep the market tends to retrace. And yeah, this is what I wanted to show you basically. Always wait for confirmation. Doesn't matter how high your entry is, even if you are all the way up in the discount area here, entering here, placing your stop loss above the swing high, you are still not safe if you're not waiting for confirmation. So always wait for confirmation. And I would say that's it. Thanks for watching. I hope it was explained well enough for you. I will continue with the Fibonacci extensions tool in the next video, and then we'll go to confirmation candles, and afterwards how to combine signals with each other. And yeah, it will be very nice. Yeah, I'd say see you the next time. Bye bye.